All right, so the next topic which we're going to talk about is about the best practices, fund administration, regulatory, and tax compliances by some amazing masters again, taking the take of master class over here. May I please request everyone to put a round of applause for Richie Sancheti, founder of Richie Sancheti Associates. A big one, everyone. Come on. Then we have Swarup Choghale, Vice President and Head, Alternative Fund Operations, SBI SG Global Security Services. Come on, everyone. And then we have Udit Sureka, Head of Products, Asset Services, Nuvama Asset Services again. Last but not the least, Vikram Bohra, Partner, Prize over here, Waterhouse Co LLP. Thank you, everyone. Come on, a big one. Come on. All right, gentlemen, are we ready to put up again one more powerhouse session out there?
Yes, yes.
Any message before we go ahead to the audience? So that you have to be optimistic or you have to be very concentrate. Anything from your side. Come on. Anyone?
I think you have to be compliant.
Great. All right. Thank you so much. Over to you, gentlemen. Thank you.
So, Richie, since we introduced the session with compliance, and our regulator has been pretty keen on making sure that we go ahead in a manner which keeps ensures the least amount of hiccups. So what's your view, or what are the key takeaways for you from the recent consultation papers or circulars that have come in with respect to AIFs particularly?
Sure. No, thanks Udit for the question, and thanks Equalify for having me here for the panel. It is a momentous day today. We are completing 1 year of our current chairperson at SEBI. So this could be a good opportunity to even reflect on how the past year has gone by, especially for the alternate investments industry here in India. We obviously started the year with a lot of hiccups for AIF applications that were stuck. Even though it's just an administrative aspect, but not getting the license on time does create a massive issue for alternate managers who are looking to raise capital. And a significant chunk of the institutional capital sort of relies on the license to be there in place. Only then, the active marketing of the product actually starts. So today, as we stand, we have seen a lot of our applications sail through with SEBI. It takes roughly about 6 to 8 weeks for an application to come across. So we are quite comfortable with where the timelines today sit. And obviously, a lot goes into the making of it. I think to go back to the question that you raised, there is very limited green field left insofar as the AIF ecosystem is concerned for the rulemaking. A lot of the rules that we have seen develop seems to be like a reaction to what SEBI has been seeing in case of the inspections that it has been conducting. I think the inspections and audit team of the SEBI has had a very robust year. A lot of AIFs, their compliances, their reporting mechanisms, how they sort of adhere to the different circulars, they've all been examined at a very granular level. This is reflective of the kind of circulars that we have been seeing coming out from SEBI. One of the panelists in the previous panel did indicate that we are expecting maybe a revision that too a significant at that on the investor ticket size. But till that happens, I think the regulations are pretty much geared towards a more retail type investor participation in today's terms, which is why you have SEBI sort of coming in with its own versions and views on how the final closing should be structured, what should be the tenure of the product, can you extend the tenure or not. Where we see challenges come up from a legal team perspective, obviously the compliances are by and large maintained in-house by a lot of the teams. Where we see these issues come up is when there are interpretation issues. For example, when SEBI said that, look here, we want you to identify the tenure of the fund linked to the date of final close, because that is when the last of the investors sort of participate in the fund. That was the position for the longest possible while. But again, a lot of funds tend to have extended final closings because investors sometimes take a little more time to sort of firm up their commitment to the fund. So obviously that leads to a challenge that the final closing date could be a moving piece. And accordingly, the linking back to the date of first closing is very helpful. But the way SEBI has done it with its circular, it suggests that you can no longer extend the final closing date if you're caught in that transitionary phase. So which is where, obviously these are unanticipated consequences because final closing date needs to be a movable date. Otherwise, the fundraising becomes a challenge. So I think it's been, you cannot fault the regulator for some of what we see today because they obviously are trying to address the situations that they see coming up before them. It is leading to some unintended consequences, which is where we have been advising our clients on how to best sort of open the dialogue with SEBI, let them know that what we are trying to do is not the intended issue that you are trying to address, and our investors on board with what we plan to do. So there is some agreed path to relief for any unwarranted consequences coming out. And that, frankly, has been the story across a lot of the regulations that we see, not just for the AIFs, but even for portfolio managers, for FPIs, some of which we will touch upon during some of the subsequent answers that we share.
Just one more question. Now, we saw that in the FPI regime, once SEBI introduced the concept of DDPs,
right,
number of registrations, participation, the breadth of participation increased. Any possibility of something like that? Do you visualize? Could that be feasible, you think, on the domestic side as well for AIFs? Or
Sure. See, I think any introduction of the DDP type mechanism could, frankly, in my mind, undermine the bespoking nature of the alternate investments platform. I think a possibly better move than a DDP parallel structure could be to enhance the ticket size. The ticket size at 1 crore rupee is something that was part of the basic regulatory framework that got introduced in 2012. Where the industry stands today, I think there is a lot more scope and appetite to deregulate some of the pieces that we see today. I think adding the DDP to the entire sort of fulcrum, obviously there can be different views and there can be conflicts in how my views are perceived right now, but I frankly feel the current regime, there is scope for deregulation as opposed to adding more SEBI-regulated intermediaries to the mix.
So, Vikram, coming to you, one of the hotly discussed, if not debated, but at least discussed topics was the distribution fees and maybe, so in that context, the setup fee and the distribution fee, how should that be charged to the fund? Let's say upfront or again, similarly on a trail basis, amortized. What are your views on that?
Thank you. Am I audible?
Yeah.
Okay. So first point is, at least as we speak, the SEBI's launched has released a discussion paper on actually regulating the quantum of the fees, not the setup fees, but at least the distribution fees in that such. My view is that one has to differentiate this product from a typical mutual fund product, and SEBI is trying to bring the same set of regulations which are there for mutual funds or similar framework of regulations over there. I know it's all about investor protection, and therefore that is at the core of regulatory regime, and it has to be there. But there are certain things that has to be left to a decision of a sophisticated quote investor. On one hand, we are talking about increasing the minimum contribution size of an investor from 1 crore to whatever that number may be, 2, 5, whatever it is. But once we do that, then we know that the investor has thought through the product proposition and the cost associated with it when they are investing. Second thing is, unlike a mutual fund which can do a public offer of the units, and there can be the raising capabilities is by having an advertisements and billboards, and a lot of fundraising can be happening through that. All the monies in the AIF has to be raised by private placement. So again, that puts a restriction or puts constraints on the ability of the fund managers to raise new capital without the help of distribution network, which they will need. And for that, there is a cost associated with it. So that these are the two reasons why first point is I think that there should be a conscious effort, whether there should be a healthy debate on whether there's a need for containing or regulating the cost of a distributor or not. The third relevant point in that construct was also this industry also has this carried interest mechanism, which is not there in the mutual fund space. Tomorrow, what if a portion of the carried interest is shared with the distributor? Is it a distribution fee? Is it a trail commission? Is it not? Nobody has an answer to those aspects. Again, this will open up, as Rishi was saying, this will open up the interpretation debate as such. So it has to be just not replicated what it has been done for mutual funds and PMSs. It has to be thought a little bit differently, because the industry spectrum is different, the clienteles are different, the investors are different, the mode of raising capital is little different. That's one point. Having said that, one thing that we have observed generally is that all the setup expenses and the distribution expenses are generally charged to the fund upfront, right? From an accounting perspective, it may still be a little bit amortized here and there, but generally they are charged upfront. Now, the reason why this issue can become relevant is also the fact that today also the subsequent closings which we raised, we do a first closing, then we do second and third and fourth. The subsequent closings actually don't really happen in, and more so keep aside the public markets and divide into public and private markets. The Cat 1 and Cat 2s and Cat 3s is separate. But the Cat 1, Cat 2s really do issue units at par value. They don't do units at NAV. There is a concept of compensating contribution which is charged in the which is there in the fund documentation. Now, when a setup expenses is loaded and for a moment, and there is a waiver clause available to fund managers for compensating contribution. The fact that if it is where funds want to do NAV based kind of issuance of units, if at all they want to even think on that lines, the setup expenses debited upfront results into a reduction of NAV, which is like if we look at it from a fairness perspective, for a moment keep aside whether it is happening, not happening, because a lot of the fund managers at industry level today don't issue units on a NAV, they just do at par, and then there is entries for compensating contribution, and this may have to be revisited at some point in time because of the tax developments. I'm not touching upon that. But if they were to do at NAVs, the units issuance, if this was to happen at NAVs, the problem statement is that the NAVs by default, if like in 2 months time, if on a second closing has to happen and the investment has not yet happened from the first round of drawdowns, the NAV comes down because of the charge of the setup expenses. So the new investor coming the second closing gets a benefit of a lower NAV, gets higher units, and with the same quantum of investments which is being done, which otherwise were done, a person notionally and hypothetically gets a little bit higher share. We can do this mathematical modeling as such, but that's the concept that therefore should we amortize it, should this be excluded in NAV calculations? Again, there are no regulations. This is just a issue. A lot of thought has not yet gone because issuance of units are still happening at par values. So therefore, nobody takes this aspect seriously, and the accounting standards, and nobody is yet debating on the accounting standards applicability and accounting issues for setup fees. But this is an interesting point to just note. Same with the distribution commission also, but distribution commission is a charge in that.
So I think if you were to do on NAV, etc., you would need a very strong accounting policy, accounting partner, and maybe a fund administrator to answer all the queries that your investors would also have. So Swarup, coming to you, what are the factors you think are relevant, broadly just a few, in terms of a fund choosing an administration partner?
Yeah. Firstly, I mean, just to set things into the right perspective, an AIF is not a mutual fund. AIF may be similar but not same. So you need to have the perspective that AIF has its own uniqueness and it cannot be compared to the mutual funds. The practices and the processes followed for a mutual fund cannot be replicated as they are for an AIF. So when we say the units are issued at existing NAVs, so in the initial year, you charge the management fees, you charge the setup fees in the initial year, the NAV drops. If the NAV drops and there is not a corresponding Hello? Yeah. So if the NAV drops and there is not a corresponding investment to substantiate the income for the fund, it would become really difficult for the fund to bring in new set of investors at the subsequent closings. So there has to be a clear-cut demarcation between the processes for a mutual fund and the processes for an AIF. Now, when an AIF has to select a fund administrator, we need to understand the model of an AIF. AIF is not a mutual fund wherein the setup is huge. You have teams for fund management, you have teams for internal processes, operations, you have a team that liaises with the RTA, the reconciliations teams are in-house. AIF works on a very lean model. So AIF, the expectations from the AIF team would be they have a fund manager who manages the alpha, you have the compliance team, which is regulatory, and all the other activities should be outsourced. That would give the real cost benefit advantage to the AIF, and which is why the fund accounting industry has an outsourced team for the AIF. Now, while selecting the AIF fund administrator, the AIF has to look into the pedigree of the fund administrator. AIF industry is very new, but the fund administrators who have served the existing mutual funds, AIFs, PMSs, they have a better understanding of the product and they are able to cater to the services of an outsourced AIF. As I again said, it is not same, it is similar. So you need to have a robust system in place. The system's robustness is judged by the capability of its turnaround time, the capability to adhere to the regulatory changes, and come up with the solution in the required time frame. Now, AIFs do not have the necessity of a 11 p.m. deadline for NAVs as the mutual fund industry has. So it has a relatively more leeway to develop processes, to develop standardized practices, and cater to the requirements. But having said that, when it's a quarter end or the month end, where the NAVs have to be delivered, the NAVs have to be delivered, the unit statements have to be released. If there are prepayments, if there are distributions, you need to cater to the distribution advices, you need to cater to the unit statements. And these are unique for every AIF. So every AIF can have their own set of account statement. Some may have the logo embedded, some may have the previous drawdown histories, some may give the amount of contributions which have been received from the other investors. So there is a uniqueness involved, and that is where the skill of an outsourced fund administrator comes into play. His ability to turn around the requirement of the client and in the available timelines and with the correct output. So the robustness of a system is the primary requirement, but systems don't work on their own. It is a very specialized skill set. You need the right talent. You need to cater to the right talent available with you so that they work on the systems. Understanding the requirement, as the previous panel said, it's human capital. So human capital can drive on what is required. The technology can take part and take its role wherein instead of 10 investors, you can cater to 1,000 investors, 10,000 investors. So having the right mix of a good human capital and the technology is the prima facie requirement of a fund administrator. Then you have the other requirements as well. You need to have a proper BCP plan. You need to have a disaster recovery site. You need to have common audits. So common audits benefits come through shared services. If an AIF regulatory requirement comes in for an information security audit or an ISAE audit, every AIF performing the audit on their own would not be a cost-efficient model. But if the AIF fund administrator has these processes in place at their end, the cost-benefit ratio is a good game changer while selecting a fund administrator. So the robustness of the system, the human capital in place, the development of technology, and the outlook which the fund administrator has. See, AIF is a very new industry and it is in its nascent stage. Probably 6 years. If you compare it with the mutual fund industry, 40 lakh crores of AUM and about 2.5 decades of experience. So this field is developing and is developing at a very fast pace. So the outlook of the fund administrator, his vision, you have foreign investors coming, foreign fund administrators coming in, the level of competition will increase. So it is good that the level of competition increases because competition brings out the best in yourself. So having but you need to have a vision. Fund administrators need to have a vision for the future. You have many bouquets of areas coming in, compliance support, investor support, transfer agencies. So these are the areas where you need to explore and you need to develop so that you present what the earlier panel said as a platform wherein all these activities can be given under the same roof. If the fund administrator has a banking lineage, the banking can provide marketing support, sales support. So that is also a new field that can come into play. So these are the various criteria that have to be looked into while selecting a fund administrator.
So in terms of the vision, do you think the current players are shaping up well, and do they have the vision to take really grasp the bull by the horns, so to say?
I'm reminded a quote from Alice in Wonderland, wherein you have to keep running if you have to stay in one place, and run twice as fast if you have to reach somewhere. So we are in the stage where we have to run twice as fast if you have to reach somewhere. You need to have that vision, and I agree with Senthil's presentation. I've seen his presentation in the earlier times as well, where Equalify had also arranged a session from his side, where KFIN is looking into developing a bouquet service. So bouquet service is the need of the hour for the AIF industry, because AIF industry has the committed capital is not enough for the AIF to have an in-house fund administrator team, an in-house RTA team, in-house reconciliation team, in-house investor services team. So instead of those in-house team, you go to a fund administrator where you develop, where you get the economies of scale, and you also get the best-in-class skill sets, because the skill set is rare. The skill set is not something that if you have done a mutual fund NAV, you go the very next day into an AIF and you are able to deliver on the AIF platform. There is a vast change required, whereas the basic concepts might be same. You have a capital, you have income, you have expense, and you get the NAV. But the way the things are structured, AIFs are probably India's answer to the hedge funds which are working abroad. So it is not an answer to the mutual fund industry, nor it is a competitor to the mutual fund industry in the terms of processes. So the distributor commissions that are there, distribution commissions, you charge them upfront, but then if the investor redeems or comes out, then there has to be a clawback of the distributor commission. If an AIF is into category 3, if you are doing normal investing, delivery-based investing, it is capital gain. But if you go into derivatives, it becomes business income. There are various different tax implications. So the tax implication side, on the development side, these are not similar. So this is the challenge which the fund administrator side is going through, wherein you need to develop a model wherein the AIF can only focus on generating alpha. And all the activities, we can even go to the scope of payroll processing. So you do not need to have an in-house HR team. So that is the vision that you need to have if you need to sustain in the AIF industry and cater to the industry as good as the fund administration is catering to the mutual fund industry.
So Richie, like we've seen in the earlier panels also in terms of how India is looking very attractive, and we've all seen multiple manifestations of it, whether in terms of FPI flows or flows coming into the domestic AIFs as well. I think one question that keeps coming up is, if you are accepting money, foreign money in a domestic AIF, right? What are the things to be mindful of? There is an obvious issue in terms of the interpretation of what an AIF is then allowed to do or not. So what are your views in terms of sectoral caps and stuff?
Sure. I think I'll start by first answering your question, and then I do have some observations on what was mentioned by the panel earlier. So to answer this question, insofar as category 1 and 2 AIFs are concerned, it just doesn't matter whose money has been sort of raised by the fund manager. It's all driven by whether the manager or the sponsor is domestically owned and controlled or not. And that's a principle which is very fairly settled and there's no debate. Insofar as category 3 is concerned, that is where some issues do crop up that, okay, if we have accessed NRI capital on a repatriable basis, as opposed to non-repatriable, which is domestic capital, or we have accessed overseas money, then us being regulated in a manner where we only invest, even though we are a category 3 AIF, in instruments and securities in which a FPI is allowed. I think somewhere the class of securities is what has been sort of forced upon the category 3 AIF and not the other bandwidth limits and other constraints. Again, that's a view, and views are bound to be plural at any given point in time. So with that, I think I'll sort of jump ship to the issue that was mentioned earlier, this whole concept of having direct plans for those investors who are coming directly into a fund, as opposed to having distribution costs loaded. whether on trail or whether on a upfront basis, I think that could lead to a very dangerous trend. And the reason I have some concerns is because that proposal from SEBI actually says that if you're an investor coming directly into a fund, then the direct scheme or direct plan sort of means that you will get enhanced number of units as opposed to an investor who came via a gatekeeper or a distributor. So there, then the question becomes a little more crucial that in what ways are we as a fund manager going to discern between the different pockets of expenses? If there are any distribution expenses to be loaded to a particular class of investors, that enhances the number of units that a direct plan investor gets. What if there is a negotiation on management fee? What if the placement agent, at the time they're a bulge bracket private wealth, they negotiated that any investor, we sort of act as gatekeeper for the fund, then our investors or LPs are going to have a slightly reduced management fee loaded onto them. Then how do you sort of pass on the benefits of the reduced management fee? The issue that it then sort of leads to is the fact that when you are generating distributions proceeds and you're allocating it to different buckets of investors, do you then sort of net off the expenses that were loaded so that some investors with a lower aggregate expense ratio get allocated higher distributions, which could be on either on account of distributions or management fee, or do you sort of look at their capital commitment or capital contribution? So a lot of these areas are something that the managers captively deal with, and it's not a call that is taken on a fund by fund basis, it's a franchise position. A lot of institutional fund managers today are raising not just domestic capital through AIFs, they're setting up funds in IFSC, they already have some existing advisory mandates or direct management mandates with overseas funds. Now, if an LP or an investor is looking to participate across some fund, they would obviously compare what have you offered in your Series 2, Series 1 fund when you're marketing to me your Series 3, and why is there a difference between how you sort of look at the expense components across the different vehicles that constitute your broader fund. So I think that is where we would definitely, have a feedback that the regulator should look at the policy level issues and sort of hold back from anything which has any operational impact, which again dovetails back to the theme for today's session on the operational challenges that the managers face. Like I said, again, it is something which is a spillover effect of the regulator trying to engage itself. It's a basic reaction to what they're seeing in the market, but again, the way it comes out, it has these spillover effects which can impact something which is as crucial as adjudicating on the management fee and allocation of distributions. I think that was one. The other piece I wanted to mention on this circular is that some of the institutional sort of placement agents, they add a lot of value, even on the fund documents, the way the fund is pitched to different segment of investors. So sometimes it gets difficult to say that, look here, who is the one who received advantage of the distributor? Was it only that bucket of investors who came via that gatekeeper, or did all the investors sort of gain because they could add a lot more credibility to the information that was mentioned, some of the fund terms that were designed. So again, there is some amount of discussion to be had there, and not something that we would believe that the regulator upfront could be best positioned. And again, because of the sinking nature of the industry, like what you do in an AIF impacts what you do in IFSC, could impact what you do overseas. Again, just to make sure there's a homogeneous process across all, homogeneous understanding of these allocation of expenses, I think it would be well advised that we should only look at very specific aspects and not dictate on the way the solution should be implemented.
Yeah, basically, low touch versus high touch. How low or high, how high do you want to go, right? And the whole idea behind creating this asset class was to let it be a low touch and get more innovation, get more differentiated products in your portfolio to give you that diversification that is much needed. So Vikram, while we've been talking about allocation of expenses, sometimes even allocation of tax can become an issue, right? So let's say if you've got realized and unrealized taxations, which investor gets allocated what kind of tax depending on their time of entry into the fund and what kind of investments have been done before or after they've come in. Don't you see challenges there as well?
So I take this point as a part of the question that we asked Swarup, right? What are the best practices that you look at in selecting, or what are the qualities you look at in selecting a fund administrator? One thing, at least as a tax professional, I can say, right? As a tax person, I find a lot of services being standardized, and a lot more thing needs to be done. And while we say global players are coming, everybody's there, a lot of customization needs because of the Indian tax aspects to the fund accounting, which becomes difficult. It's not simple. First, we had a loading of the same mutual fund systems into the fund accounting, which Swarup was referring to. But again, mutual fund is a tax exempt bracket. This is not a tax. This is a taxable or sometimes a pass-through bracket with the same allocations happening. So a lot more differentiated systems and processes are needed. Reporting is needed for an AIF industry. That takes me to that point, and there are 2-3 areas in that. So first is, for example, when we even in a Cat 1, Cat 2 world, right? When we have to report back to the investors of distribution, what is the nature of your distribution? Is it a repayment of your contribution back? It is a repayment of your capital gains. It is a repayment of your income elements. Is the distribution reconciled with the fact what is your taxable income? And it is not necessarily reconciled. I'll give a couple of examples. For a moment, let's go an assumption that an AIF computes taxes on index cost and indexation benefits are taken by the AIF in computing the tax rates. In that case, the actual distribution that may happen to the investors may be a little different or maybe more than the actual capital gains tax being charged in that sense. So if you give an income statement show a lower income in that sense, but the distribution is little higher. So does our systems do that? Right? That is one example that I can put it. The second example is some investors, and I'll give this unrealized realized is a real we make is a very passing remark to Cat 3 players particularly. But really, when it comes to the core, it's the fund accounting accountants who have to actually handle the load of it. So the big question which remains is redemption a taxable event? Because it's more in an open-ended world or in a closed-ended world where there is an exit option. Now, typically we don't see these redemptions in Cat 1 and Cat 2s because there it's just distributions and we don't give an exit option. We don't see when investors really exiting that way. At max, there are secondary transfers if at all there are. But we don't see an exit event in terms of investors going out of the fund and they getting distributed. The key question was, and I'll give a simple, explain this with an example. Suppose the fund has raised 100 CR and it invested into markets and public markets. The NAV was 150 CR, right? And assuming for a moment entire 150 CR is, that entire incremental 50 CR is represented by unrealized income. Now, if we were investors of 25 CR each at that point in time, each of the shares becomes 37.5 CR in that sense as an NAV. If I come and exit and I go and ask for an exit, what happens is they have to sell at least a securities worth 37.5 CR, but the tax on this will have to be borne by all four because the tax is at the fund level and tax will have to be borne by all four. The mechanism that I was trying, and again we make a state, or against, even at that time, suppose in an open-ended fund, somebody else is putting 37.5 and they are giving me an exit of 37.5. Can I allocate a realized gains to me only and unrealized gains to the 3 people and say, okay, here is your realized gains, whatever is attributed only because you are exiting. I'm allocating this to, therefore the tax on this is to your charge. This is not to your charge. Thereby also trying to give to a tax office that this is just a redemption, is just a mechanism, but it is not a transfer, it will tantamount to double taxation. All those arguments become relevant. But these all has to be supported by the fund accounting when the system throws up. If system doesn't help me out, this remains just a talk for me and in conversations, okay, this can be mitigants. It will never be get implemented out. But this realized, unrealized allocations, exit is a real challenge if this can be solved by the fund accounting industry and administrator industry as such. Otherwise, that's the reason why I said you can do allocation of realized.
And realized, unrealized throws up some very interesting issues as well. What if you've charged on unrealized and subsequently there was no tax liability that actually needed to be borne, right? Now the fund has some extra money lying with it. What could be done with it? Like, any of you have a view, Richie or Vikram?
So let me take this up. My view is that belongs to the rest of the investors. That the benefit has to go to the rest of the investors. It cannot go back to the exiting investor. So I'll take an example, right? If 37.5 CR was the value of say my investments and I was exiting it out, there is a component also of unrealized portion, and on that there is a notional tax which has been charged to me and saying, okay, now you exit. This is a notional tax charge. We are recovering this money from you, and we are. The fund may not necessarily pay tax on that because the fund may not have entirely earned, paid unrealized taxes in that sense. The fund may still put as a tax reserve, whichever may happen. The tax reserve actually belongs, like any reserves and surplus, belongs to the unit holders which are there on the ultimate distribution date. So as and when the fund either distributes, liquidates, whoever the investors are, that in my view should belong to them, not to the original investor. You cannot have a mapping. You cannot try and track this reserve balances back to the investor who had paid this monies from. So I don't think that is humanly possible, or that is even legally want to get it. It belongs to the rest of the investors who stayed back. So it has to be belonging to the investors, rest of the investors in the fund.
I think for paucity of time, we'll have to bring this session to an end, but I guess we can take a couple of questions. So if you have any questions for our panelists here. There's a tax guy, there's a lawyer. I'm surprised there are not questions. I think we can close it there.
All right, no questions. So in that case, that was again an amazing session, gentlemen. Thank you so much. Everyone, a big round of applause for this such informative session out there. All right, so felicitation, may I please call on stage MS Chandrasekhar, co-founder and executive chairman, Hexagram. Everyone, a big one for them. And the time for group picture, please. Thank you so much, gentlemen, for giving your valuable time out there. All right, so before moving ahead, anybody hungry? Yes? Oh, let's go? All right, so I believe in stopping work and eating lunch. Let's have a networking lunch today by Equalifi and K FinTech. Thank you, everyone. We will be joining back in 45 minutes. I request you to please set your clocks. 45 minutes. Thank you.